Are you ready to master the art of Forex trading and safeguard your hard-earned capital like a pro? Welcome to another exciting episode of our Forex trading series. Today, we're delving into a critical aspect of trading that separates the pros from the amateurs: Forex risk management. Protecting your capital is paramount, and we'll show you how to do it like a seasoned trader. Let's get started. The importance of risk management. Before we dive into the nitty-gritty of risk management, let's understand why it's crucial. Risk management isn't just a strategy, it's a mindset. Here's why it's so vital. Capital preservation. Effective risk management ensures you don't wipe out your account with a single bad trade. It's like a safety net for your trading journey. By limiting your exposure on any single trade, you protect your trading capital from catastrophic losses, allowing you to live to trade another day. Emotional control. Managing risk helps you stay calm and collected, preventing emotional trading decisions. When your hard-earned money is on the line, emotions like fear and greed can cloud your judgment. A well-structured risk management plan acts as a shield, keeping these emotions in check and allowing you to make rational decisions. Long-term sustainability. Consistent risk management is the key to longevity in the trading game. Trading isn't a sprint, it's a marathon. Traders who prioritize risk management over reckless gambling can stay in the game for the long term. It's about preserving your trading capital and gradually building it over time, rather than risking it all on a single roll of the dice. The 2% rule. One of the golden rules in risk management is the 2% rule. This rule dictates that you should never risk more than 2% of your trading capital on a single trade. Let's break it down. If your trading account has $10,000, your risk per trade should be limited to $200. 2% of $10,000. This ensures that even a series of losses won't cripple your account. Stop-loss orders. Stop-loss orders are your best friends in the world of trading. They are predetermined price levels at which your trade will automatically close, limiting your potential losses. Here's why they are crucial. Discipline. Stop-loss orders enforce discipline by preventing you from holding on to losing positions out of hope or fear. When the market moves against your trade, it's easy to become emotionally attached to your position. Stop-loss orders act as an impartial referee, ensuring that you adhere to your trading plan, no matter how tempting it may be to let a losing trade linger. Emotional control. They take the emotional aspect out of trading decisions, ensuring you stick to your trading plan. Trading can be an emotional roller coaster, and emotions can cloud your judgment. Stop-loss orders provide an objective way to manage your trades, preventing you from making impulsive decisions based on fear, greed, or hope. Capital protection. They are a shield that protects your account from significant losses. In the financial markets, the preservation of your capital is paramount. Stop-loss orders act as a protective barrier, limiting the amount you can lose on a trade. They are your insurance policy against unforeseen market movements that could otherwise devastate your account. Position sizing. Position sizing is the art of determining the number of lots or units you'll trade in a position based on your risk tolerance and the distance to your stop-loss. Here's how it works. If your risk on a trade is $200 and your stop-loss is 20 pips away, you can calculate your position size to keep the risk within your 2% limit. It's a crucial tool to align your trade size with your risk tolerance. Risk-reward ratio. The risk-reward ratio is a critical component of risk management. It defines the relationship between your potential profit and your risk. The rule of thumb is to aim for a positive risk-reward ratio, such as 1 to 2 or 1 to 3, which means you're willing to risk $1 to potentially gain $2 or $3. Let's explore why this is important. A positive risk-reward ratio allows you to make profits even if you're right less than half the time. In trading, you don't need to be right all the time to be profitable. With a favorable risk-reward ratio, you can win less than half of your trades and still come out ahead. This is because your winning trades can potentially bring in more than your losing trades take away. It encourages you to find high-probability setups with good potential returns. When you aim for a positive risk-reward ratio, you naturally seek out trades with a higher likelihood of success. It pushes you to focus on setups where the potential reward justifies the risk, making your trading strategy more selective and, potentially, more profitable in the long run. Diversification. Diversification is a risk management strategy that involves spreading your risk across different assets or currency pairs. This way, a losing trade in one asset might be offset by a winning trade in another. The benefits of diversification include reduced risk. By not putting all your eggs in one basket, you're less vulnerable to sharp losses. Steady returns. Diversification can lead to smoother equity curves, reducing the volatility of your trading account. Risk management tools. Technology has brought us several risk management tools to assist traders. Some of the most commonly used ones include Position Size Calculator. These handy tools help you calculate the appropriate position size based on your risk percentage and stop-loss distance. Volatility indicators. Understanding market volatility can help you adjust your position size and stop-loss levels accordingly. Correlation analysis. By analyzing the correlations between different currency pairs, you can avoid overexposure to a single currency. Trailing stop orders. These allow you to lock in profits as a trade moves in your favor, reducing risk as the trade progresses. Psychological aspects of risk management. Lastly, let's not forget the psychological aspect of risk management. It's not just about numbers, it's about discipline and mindset. Here's how to strengthen your mental risk management. Stay emotionally detached. Emotions like fear and greed can lead to impulsive decisions. Stick to your plan. When trades don't go as expected, it's easy to let emotions take over and make rash decisions. To enhance your mental risk management, practice staying emotionally detached from the outcomes of individual trades. Trust your strategy and discipline, even when the market gets turbulent. Accept losses. Losing is part of the game. Don't let it demoralize you, learn from it. In trading, losses are inevitable. Every trader, no matter how experienced, faces losing trades. Instead of letting losses demoralize you, view them as valuable lessons. Each loss can provide insights and improve your trading skills. Embracing losses as part of the learning process is a crucial aspect of psychological risk management. Patience. Be patient and disciplined. Wait for the right setups and opportunities. Impatience can be a significant obstacle to effective risk management. Traders often rush into trades out of fear of missing out or impatience. To strengthen your psychological risk management, cultivate patience and discipline. Wait for the right setups that align with your strategy and risk-reward criteria. This patience can help you avoid unnecessary losses and stick to your risk management plan. In conclusion, risk management is the cornerstone of successful trading. It's not about avoiding losses altogether, it's about minimizing them and letting your profits run. Remember the 2% rule, use stop-loss orders, calculate your position sizes carefully, and aim for a positive risk-reward ratio. Combine these strategies with the right mindset, and you'll be on your way to protecting your capital like a pro. Thanks for joining us today, and happy trading!